All right, knowledge explorers, welcome back. Here on the deep dive, you know our goal, right? We love to take these big, sometimes tricky ideas and just make them crystal clear.
Get to those aha moments.
Exactly. And today, oh boy, we're diving into something that might sound a bit technical on the surface, but trust me, it's absolutely crucial for, well, pretty much any organization out there. We're talking about the hidden world of internal controls and business processes.
Yeah, you could almost think of it like the unseen plumbing or wiring in a building.
Ooh, I like that. The architecture that keeps the financial gears turning smoothly, reliably.
Precisely. And we're really aiming to go beyond just the definitions today. We want to understand how auditors actually look at a company's inner workings,
Right.
the systems, the procedures, all designed to make sure that financial information isn't just numbers on a page, but something you can actually rely on, something accurate.
It's about trust, isn't it?
Fundamentally, yes.
Mm-hmm.
Building trust in those numbers. And the really interesting thing, I think, is that the insights we'll dig into today, they're surprisingly universal. Doesn't matter if it's a tech giant or a local bakery.
Okay, so we've got some really illuminating material lined up. Our mission, should you choose to accept it, is to pull out the most important nuggets, maybe challenge some assumptions, and hopefully give you some surprising facts you can just, drop into conversation.
Sounds good.
So lay it out for us. What's the roadmap for today's deep dive?
Okay, so we're going to focus on how auditors really get their heads around an entity's internal control system. What is it?
Okay.
Then we'll look at the different kinds of controls you might find. They're not all the same.
Right.
We absolutely have to talk about information technology, IT, because its impact is just profound.
Elsewhere.
Everywhere. And then we'll walk through the meticulous steps auditors actually take to understand and, importantly, evaluate these systems.
So it's a journey into what? Precision, critical thinking.
All of that. It's what underpins financial integrity, really.
Okay, perfect. So with that big picture, let's zoom in. When we say internal control, stripping away the jargon, what are we really talking about? What's its fundamental job in a company?
Yeah, good place to start. At its absolute core, internal control is basically the whole collection of processes and procedures that a company puts in place.
Okay.
And the goal is to make sure it achieves its objectives. Now, that's broad, but especially when it comes to financial reporting. That's a key focus for auditors.
Gotcha. Reliable numbers.
Exactly. Reliable numbers. And our source material, it helpfully breaks this down into 5 key components. Think of these as the pillars supporting the whole structure.
Okay, what are they?
So first, you've got the control environment. This is kind of the big picture stuff, the tone at the top, the company's ethics, integrity, how seriously they take controls overall.
Culture, almost.
Very much so. Then there's risk assessment. How does the company identify risks that could mess up its financial reporting, and what does it do about them?
Makes sense.
Third is information and communication. How does important financial information get captured, processed, and shared, both internally and externally? Is the communication clear, timely?
Okay.
Fourth, monitoring activities. How does the company keep an eye on its own internal control system to make sure it's working over time? Are they checking up on it?
It's self-assessment.
Exactly.
Yeah.
And finally, number 5 is the actual control activities. These are the specific policies and procedures, the rules, the checks, the balances that help ensure management directives are carried out and risks are addressed. Think approvals, reconciliations, things like that.
Okay, so those 5. Control environment, risk assessment, info and comms, monitoring and control activities. That gives auditors a framework.
It does. It provides a really useful structure to think about it.
But once we understand those 5 components, what's the auditor's real focus? Is it just about, checking off boxes for each component? Yep, they have risk assessment. Or is it deeper?
That's a really crucial distinction. It's absolutely deeper than just checking boxes. The auditor's primary concern isn't simply classifying controls into those 5 buckets, or even just confirming they exist on paper.
Okay.
The real question, the acid test, is whether a specific control, whatever it is, effectively prevents problems from happening in the first place, or detects them quickly if they do happen, and then allows them to be corrected.
Prevent, detect, correct.
Exactly. Prevent, detect, correct material misstatements. Those are the magic words. Control might look brilliant in a flowchart, but if it doesn't actually do one of those things effectively for significant errors,
Then it's not really helping.
precisely, its classification is secondary.
Yeah.
The core insight here, the thing to really grab onto, is that effectiveness is the ultimate measure. Does it work? Does it safeguard the data? Does it ensure reliability? That's what provides trust in the numbers.
That makes total sense. Effectiveness, not just existence.
Mhm.
Okay, so how far does the system reach? Is it just the finance folks who need to worry about internal controls, or does it spread throughout the whole organization?
Oh, it's incredibly pervasive.
Mm.
And that's a really important point our source material emphasizes. The system of internal control isn't confined to the accounting department. It's relevant to the entire entity,
The whole thing.
the whole thing. Every operating unit, every single business function, think about HR, sales, manufacturing, R&D, IT controls, are relevant everywhere.
Wow.
And those 5 components we just talked about, they apply conceptually to the audit of every entity. Doesn't matter if it's a tiny nonprofit or a huge multinational corporation.
So the principles are the same, even if the scale is different.
Exactly. The principles are universal. Now, why does it matter beyond just financial reporting? Because these controls, when designed well, also support the effectiveness and efficiency of operations, making sure the business runs well, and compliance with laws and regulations. So while our focus today is mostly financial, remember, these principles underpin pretty much all of an organization's objectives.
Okay, that's a really broad reach. But given that reach, surely a small tech startup doesn't implement controls the same way a massive established bank does, right? Does everyone approach this identically?
Not at all. You've hit on a key point. The application and the relative importance of these control components can vary significantly based on the specific entity. Several factors come into play.
Like what?
Well, first, size. A small startup might rely more on direct owner oversight, fewer formal documented procedures. A multinational corporation needs complex, highly formalized systems just to function. Then there's organizational structure. Is it a flat structure where everyone reports to the boss, or a multi-layered bureaucracy? That changes how controls are designed, implemented, monitored.
Okay.
Complexity is huge.
Mm.
A company with one product line sold locally has very different risks and control needs than one juggling multiple products, international markets, complex supply chains.
Mm-hmm.
Their information processing methodology matters a lot too. Are they running sophisticated, integrated ERP systems? Or is
Yep.
it more manual, maybe spreadsheet-based? The controls needed are vastly different.
I can see that.
And even ownership management characteristics.
Mm-hmm.
Are the owners actively running the show day to day? That might mean less need for some formal controls, because they are the control in some ways. Or is there a clear separation between owners like shareholders and professional managers that usually requires more robust, independent controls?
So lots of variables.
Exactly. And because of all this variability, the auditor doesn't necessarily need to understand every single component in the same exhaustive detail for every single audit. It comes down to professional judgment.
Tailoring the approach.
Precisely. Tailoring the approach to the entity's specific size, complexity, risks, and how it operates.
Okay. Now, I've definitely heard people talk about frameworks like COSO. Are auditors kind of locked into using that specific one? Or is there flexibility?
That's a great question. COSO, which, for listeners, stands for the Committee of Sponsoring Organizations of the Treadway Commission, is definitely, let's say, the dominant player. It's widely recognized, very influential.
Right.
But no, auditors aren't strictly locked into it. Entities themselves might use other established frameworks, or sometimes they might have developed their own system over time without explicitly labeling it under COSO or anything else.
So the label doesn't matter as much as the substance.
Exactly. From the auditor's perspective,
Yeah.
the key thing is whether the principles of sound internal control are being addressed. Do they cover those 5 core components we talked about, regardless of the terminology? Are the controls designed and operating effectively? So an auditor can certainly use the COSO framework as their benchmark, and often they do because it's comprehensive. But if the company uses a different framework, or none formally, the auditor just needs to ensure that all the essential concepts, control environment, risk assessment, and so on, are adequately covered and functioning. The goal is a robust assessment, whatever the label.
Oh, so if auditors aren't looking at absolutely every single control, because, wow, that could be thousands in a big company, how do they zero in on the ones that really matter for the financial statements? What guides that selection? It must be about efficiency too, right?
Absolutely. Efficiency is key. You can't boil the ocean. It's a very targeted approach, and it's driven by risk. Auditors focus on controls relevant to addressing the risks of material misstatement at the assertion level.
Okay, assertion level. Break that down quickly.
Sure. Assertions are basically the claims management makes in the financial statements.
Yeah.
Like, they assert that all the revenue recorded actually occurred, existence assertion,
Yeah.
or that all the expenses that should be recorded are recorded, completeness assertion, or that assets are valued correctly, valuation assertion.
Got it. So controls related to those specific claims.
Exactly. And the source gives us specific criteria auditors use to pinpoint these relevant controls. It helps them prioritize effectively. First, and maybe most obviously, controls that address a significant risk. If the auditor identifies an area with a high likelihood of a major misstatement, maybe due to complexity, judgment, or even a heightened risk of fraud, then the controls designed to mitigate that specific risk are immediately relevant.
Okay, focus on the big potential problems first.
Right. Second, controls over journal entries and other adjustments, especially manual journal entries or adjustments made outside the regular automated flow of transactions.
Why those specifically?
Because they often involve more judgment, less automation, and sometimes bypass standard controls. They can be a place where errors or even intentional manipulation might occur. So controls around authorization or review of journal entries are critical.
Makes sense. High risk area.
Third, controls the auditor plans to rely on to reduce other testing. This is a strategic decision. If the auditor thinks certain controls are really strong, they might test those controls to confirm they're working effectively.
Okay.
And if they are working, the auditor can then justify reducing the amount of other more detailed testing, what we call substantive procedures, like checking individual invoices or bank balances.
So testing the controls saves work elsewhere.
Potentially, yes,
Yeah.
if the control is reliable. So any control the auditor plans to rely on must be identified and tested for its operating effectiveness. It directly impacts the audit plan's nature, timing, and extent.
Okay, smart.
And fourth, there's a bit of a catch-all. Controls deemed appropriate by professional judgment. Sometimes, based on the auditor's experience, their understanding of the specific business, the industry, their overall risk assessment, they might identify other controls as crucial, even if they don't perfectly fit the other categories.
So the auditor's own expertise plays a role.
Absolutely. It acknowledges that auditing involves judgment, not just following a rigid checklist.
Got it. Okay, and you mentioned IT earlier. Beyond these general financial controls, why does IT get called out specifically?
Because IT is just so foundational to everything now. Think about it. Almost every significant business process, sales, purchasing, payroll, inventory, financial closing, relies heavily on IT systems.
True.
So the auditor has to identify not only the specific IT applications that are important for financial reporting, like the accounting software, the sales system, etc., but also the specific risks that arise just from using IT. Things like unauthorized access, data breaches, system failures, inaccurate processing, cyber attack.
Yeah, the list is long.
It is. And crucially, they must also identify the general IT controls that the company has in place to address those IT-specific risks. These are controls over things like system access, cybersecurity, managing software changes, data backups.
So it's like controlling the IT environment itself, not just the data in it.
Exactly. It's recognizing that if the underlying IT infrastructure isn't secure and reliable, then the financial data processed by that infrastructure can't be trusted either. It's absolutely central.
Okay, this next distinction seems really practical and important to grasp. Our sources talk about controls being either preventative or detective. Can you walk us through that? What's the difference, and maybe give us some clear examples?
Absolutely. This is a fundamental concept. Think of it maybe like securing something valuable, say your company's critical financial data. You need layers of defense. On one side, you have preventive controls. These are proactive. They're designed, ideally, to stop errors or irregularities from happening in the first place.
So they're like the strong walls, the locked doors.
Exactly.
Yeah.
They aim to provide reasonable assurance that only valid transactions get recognized, approved, and processed. They act as barriers. Most preventive controls happen before an activity or transaction occurs.
Okay, examples.
Sure. A really basic one is hiring competent, ethical people. Sounds simple, but skilled, trustworthy employees are less likely to make mistakes or commit fraud. That's preventive.
Right, starting with the right people.
Then, thorough personnel training.
Yeah.
Making sure employees know the right procedures, how to use systems correctly, what the policies are. That prevents errors due to misunderstanding. Segregation of duties is a classic preventive control. We touched on it, ensuring no single person controls a transaction from beginning to end. The person requesting a purchase shouldn't be the same person approving it and paying for it. That division prevents opportunities for error or fraud. And technology-related controls are huge here. Think firewalls blocking unauthorized network access, strong passwords preventing unauthorized logins, antivirus software stopping malware. These are all designed to prevent bad things from getting in or happening. Security configuration management, making sure systems are set up securely from the start.
Okay, so that's preventive stopping things beforehand. What about detective?
Right, so detective controls are reactive. They don't necessarily stop the error or irregularity from occurring initially, but they're designed to find it quickly after it happens so it can be corrected.
So these are the alarm systems, the security cameras recording what happened.
That's a perfect analogy. They kick in after processing has happened or after an event has occurred to provide reasonable assurance that problems are discovered and corrected on a timely basis.
Okay, examples of detective controls.
A very common one is performing account reconciliations, like comparing the company's cash balance in its accounting records to the bank statement. If there's a discrepancy, the reconciliation process is designed to detect it, maybe a check cleared that wasn't recorded or vice versa.
Right, done after the fact to find differences.
Exactly. Another IT example, intrusion detection systems. These monitor network traffic for suspicious patterns or unauthorized access attempts. They don't prevent the attempt, but they detect it and raise an alarm.
Okay.
Or monitoring system incident logs, regularly reviewing logs of system activity, who logged in, what files were accessed, were there system errors. This review, happening after the events, can detect unauthorized actions or processing problems. Reviewing exception reports generated by systems falls here too.
So preventive tries to stop it, detective tries to find it quickly if it happens.
Stu got it. And ideally, you need a good mix of both. You can't prevent everything, so you need strong detection too. The real strength comes from layering these controls.
Now, does the auditor need to, find and analyze every single preventative and detective control the company has? That still sounds like a lot.
No, definitely not. And that comes back to professional judgment and efficiency. The auditor doesn't need to identify or assess all controls relevant to financial reporting. There might be overlaps, or some controls might be less critical.
Okay.
The key is to use professional judgment to focus on the controls that are most relevant to addressing the identified risks of material misstatement. It's about ensuring the assessment of control risk. The risk that controls won't catch an error is based on the controls that truly matter. It keeps the audit focused and effective. #tag the profound effect of information technology on internal control.
Okay, we keep circling back to IT, and it really feels like it's woven into everything these days. How does technology specifically impact those 5 core components of internal control? We started with control environment, risk assessment, and so on.
It has a truly transformative effect. Yeah, it touches pretty much every aspect, sometimes strengthening controls, sometimes introducing new complexities or risks. Our source material breaks this down nicely across the components. First, the control environment. Remember, that's the tone at the top, management's attitude. Well, if management doesn't take IT risks seriously, maybe they underinvest in cybersecurity, or don't ensure they have competent IT staff, or ignore data privacy regulations that can significantly weaken the overall control environment.
So ignoring IT sends a bad signal overall.
It really does. It suggests controls aren't a priority, which can permeate the whole organization. Conversely, strong IT governance supports a positive control environment. Second, risk assessment. Here, IT can actually be a huge enhancer. Modern IT systems can provide much more timely, detailed, and granular information than manual systems ever could.
How so?
Think about real-time dashboards monitoring sales trends, automated alerts for unusual transactions, sophisticated data analytics identifying potential anomalies. IT can allow companies to spot emerging risks or control weaknesses much faster.
Okay, so IT can help identify risks better.
Definitely.
Uh.
Third, information and communication systems. Today these systems are predominantly IT-based. How data is captured, think point-of-sale systems, process accounting software, stored databases, and reported, financial reporting tools, is all shaped by IT.
Right.
So the quality, reliability, and security of the IT system directly determines the quality, reliability, and security of financial information and how it's communicated. A clunky or insecure IT system hinders effective control.
Makes sense. Garbage in, garbage out, amplified by tech?
Pretty much.
Yeah.
Fourth, monitoring activities.
Mm.
As we mentioned, companies monitor their own controls. A lot of the data used for this, monitoring performance reports, system logs, exception reports, comes from IT systems.
Okay.
So if the underlying IT system generating that monitoring data isn't accurate or reliable, then the monitoring activities themselves are built on a shaky foundation. You can't effectively monitor with bad data.
Right. The monitoring is only as good as the info it gets.
Precisely. And finally, fifth, control activities. IT has a massive impact here. Many controls that used to be done manually, like checking calculations or matching documents, are now automated within software. Furthermore, Even when a control is performed by a person, user control, its effectiveness often depends entirely on the information that the IT system provides to that person.
Mm.
If a manager is supposed to approve expenses based on a system report, but the report is inaccurate.
The approval control might fail even if the manager does their part.
Exactly. It highlights this deep interconnectedness. IT systems aren't just subject to controls, they are critical enablers or disablers of controls throughout the entire organization.
Okay, so it's clear IT is huge, but it's not only tech, right? Our sources talk about this blend, this mix of manual controls and automated controls. What's the best use case for each? What are their strengths and weaknesses?
Yeah, this is a really important distinction because you're right, most modern systems rely on a combination. It's rarely all one or the other. It's about finding the right tool for the job. Let's start with manual controls. These are obviously performed by people. They're generally more suitable when you need judgment, discretion, flexibility, or you're dealing with things that are hard to predict or program.
Okay, like when?
Think about large, unusual, or non-recurring transactions. A major acquisition, a complex lawsuit settlement, selling off a whole division, these often don't fit standard automated rules. You need human oversight to evaluate the specifics of the nuances, the risks involved,
Right, requires human judgment.
or situations where potential misstatements are difficult to define or predict. Maybe it's a new type of risk, or something based on subjective estimates. An algorithm might struggle, but an experienced person might spot inconsistencies or red flags.
Hmm.
Also, when circumstances change rapidly and require quick adjustments to controls, humans are generally more adaptable than trying to reprogram a complex system on the fly.
Okay, so adaptability and judgment are key for manual, like that CFO reviewing the big one-off deal we mentioned.
Exactly, that's a prime example.
Hmm.
Manual controls are also essential for monitoring the effectiveness of automated controls. Someone still needs to review the exception reports the system spits out or investigate anomalies flagged by the automated system.
Right, the system needs oversight.
But manual controls have weaknesses. They can be more easily ignored or overridden by individuals, especially if someone is determined to do so. Collusion between people can bypass them. And crucially, they're less consistent. People get tired, distracted, make errors. Performance varies.
Okay, inconsistency is a risk. What about the other side, automated controls?
So automated controls are performed using IT. They're built into the software or hardware. They shine in situations demanding consistency, speed, and handling large volumes.
Like one.
Ideal for high volume or recurring transactions. Think processing thousands of online orders daily, calculating payroll for hundreds of employees every 2 weeks, or updating inventory levels constantly. Automation handles this reliably and efficiently without fatigue or typos.
Yeah, humans couldn't keep up.
Exactly. And they're great for control activities that can be adequately designed and automated. Processes with clear, objective, repeatable rules. For instance, an automated system check that verifies a customer's credit limit before processing a large order. Or automatically calculating depreciation based on predefined formulas.
So where the rules are clear, automate it.
Pretty much. Automated controls are often embedded right into the IT infrastructure. Maybe it's a setting in the accounting software, a routine built into a database, or even a physical device like a firewall. Because human involvement is minimal once they're set up correctly, they significantly enhance accuracy, timeliness, efficiency, and often security. They enforce consistency and reduce the opportunity for human error or bias. They really support the integrity of the system.
So the takeaway isn't really humans versus machines.
Not at all. The takeaway is that effective internal control leverages the strengths of both. Manual controls provide the judgment, the adaptability, the oversight. Automated controls provide the tireless precision, the consistency, the scale. It's about the strategic blend.
Okay, this is where we get into the real nitty-gritty of the IT side, isn't it? Our source breaks down these IT controls into two main types: general IT controls and information processing controls. Let's start with the general ones. What are they guarding?
Right. General IT controls, GITCs, are like the foundation. They're policies and procedures that support the effective functioning and overall integrity of the entire information system environment, not just one specific piece of software.
So they're broad.
Very broad. They address risks that arise simply from the use of IT itself across multiple systems and applications. Think of them as the rules of the road for the entire IT infrastructure. They can be categorized by the IT area they relate to, like controls over applications themselves, how they function, how data gets in and out, how they talk to other systems.
Okay.
Controls over the database, protecting the core financial data from unauthorized changes or corruption. That's obviously critical.
Yeah.
Controls over the operating system, the underlying software, like Windows or Linux. If someone gets administrative control here, they could potentially bypass almost anything else.
Ah, the keys to the kingdom.
Sort of, yeah.
Hmm.
And controls over the network, how different systems are connected, who can access the network remotely, how users are authenticated, securing the pathways data travels on.
Okay, so really foundational stuff. Before an auditor even digs into, say, sales transactions, they're looking at how well this underlying IT structure is controlled.
Absolutely. Because if the foundation is weak, everything built on top is suspect. The source gives some excellent concrete examples of these GITCs, showing how comprehensive they need to be. First, a big category, controls. Related to managing access, this is all about who gets in and what can they do. Authentication, making sure users are who they claim to be. Strong passwords, multi-factor authentication, that code to your phone, maybe biometrics. The basics, but critical. Authorization. Once you're in, what are you allowed to do? This is about granting access only to the information and functions needed for someone's job. Enforces segregation of duties in the system. Provisioning and deprovisioning. This is the whole user life cycle. Setting up access correctly when someone joins or changes roles, and just as importantly, removing access promptly when they leave or don't need it anymore. Orphaned accounts are a huge vulnerability. Privileged access management. Special, tighter controls for those system administrators with powerful access. More monitoring, more restrictions. User access reviews. Periodically checking who has access to what to make sure it's still appropriate. People's roles change. They might accumulate unnecessary permissions over time. Security configuration. Setting up the system securely in the first place, disabling default passwords, closing unused ports, applying security patches, basic hygiene. Physical access controls. Don't forget the physical side. Locks on server room doors, surveillance, visitor logs. Can't remotely hack a server if you can physically unplug it or plug something malicious in.
Wow, okay, that's a lot just under access. What else falls under general IT controls?
Second major area, controls related to changes to the IT environment. Making changes to software or systems is inherently risky if not managed well. Change management process. Having a formal, documented process for any changes, whether it's a software update, a new module, or a configuration tweak. This includes steps for requesting the change, developing it, testing it thoroughly in a separate environment, getting approval, and then carefully migrating it to the live production system. This prevents accidental errors or unauthorized code getting in. Segregation of duties over change migration. Super important. The person who writes the code or configures the change shouldn't be the same person who pushes it live. You need that independent check. System development acquisition process. How does the company handle bringing in entirely new systems? Is there a structured process for development, testing, implementation, and crucially, data conversion, moving data accurately from the old system to the new one?
Okay, managing change carefully. What's the third area?
Third is controls related to managing IT operations. This is the day-to-day running of the systems, job scheduling and monitoring. Many critical financial processes run automatically as batch jobs, like end-of-day processing. Controls are needed over who can schedule these jobs, monitor their successful completion, and investigate failures. Backup and recovery, essential. Regularly backing up critical financial data and having a tested plan to restore it quickly if there's a disaster, hardware failure, or ransomware attack. Without this, a single event could be catastrophic. Intrusion detection prevention, continuously scanning and monitoring the network and systems for signs of attack, vulnerabilities, or suspicious activity. Being proactive about security threats.
Okay, so those general IT controls cover the whole environment. What about the information processing controls you mentioned? How are they different?
Right, so if GITCs are the foundation and the environment, information processing controls are more specific. They apply within specific applications or business processes to ensure the data itself is processed correctly. They can be automated or manual.
So these are the checks inside the accounting software or the sales processing system?
Exactly. They focus on ensuring transactions actually occurred, validity, were properly authorized, are recorded completely and accurately, and are reported correctly. It's about the integrity of the data flow. Examples include controls over interfaces and integrations, making sure data passed between different systems, like inventory updates flowing to the general ledger, is complete and accurate. Automated calculation checks, the system verifying mathematical accuracy on invoices or reports. Maintaining and reviewing control accounts and trial balances. Ensuring things foot and balance correctly within the accounting system. Input validation checks. These are really common, like the system rejecting an order if the customer ID doesn't exist, or if a date is entered in the wrong format, or if a required field is left blank. Stops bad data at the entry point. Manual follow-up of exception reports. The system might flag transactions over a certain dollar amount or transactions with unusual characteristics. A person then reviews these exceptions to ensure they're legitimate. Manual follow-up of exception reports. And looking ahead, our source mentions controls over emerging technologies, AI, blockchain, robotic process automation, RPA. As companies adopt these, auditors need to understand and evaluate the new controls specific to those technologies.
Okay, this sounds like where the auditor really rolls up their sleeves and gets hands-on. Our sources talk about doing walkthroughs. What exactly is that, and why is it so fundamental?
A walkthrough is absolutely a cornerstone. Yeah, it's how the auditor moves from just reading documentation or hearing descriptions to actually seeing how things work.
Okay.
The main goal is to trace the flow of a transaction or the key steps in processing a type of transaction all the way through the company's system. From the very beginning, like when an order is first received, through all the processing steps, including how IT systems are involved, approvals, recording, right up until it hits the financial statements. Like following a single sale until it becomes part of the revenue number.
So literally walking the path of the data.
Exactly. And the purpose is really threefold. One, confirm, understanding. Did I understand the process correctly based on my earlier inquiries and document reviews? Does it really work the way they said it does? It verifies the auditor's mental map. Two, evaluate design effectiveness. Looking at the process step by step, does the design of the controls seem effective? Are the controls placed logically? Would they, if operating properly, actually prevent or detect potential errors? It's like checking the blueprint. Three, determine implementation. And this is crucial. Have these controls actually been put into practice? Are people really doing them? A perfectly designed control is useless if nobody follows it.
Okay. Confirming, evaluating design, determining implementation. How do they actually do a walkthrough? Do they just pick one transaction and follow it religiously?
They have a couple of common approaches. They might select one single transaction, yes, and trace that specific one from cradle to grave through every single process and step and control point. That gives a really deep end-to-end view for that one instance. Alternatively, especially for high-volume processes, they might identify the key steps involved in processing a whole class of transactions, say, all credit sales. Then, they perform their procedures at each key step, but maybe using different transactions as examples at each step.
Ah, so they don't have to use the same invoice for the approval step, the shipping step, and the billing step.
Exactly. They might look at one invoice's approval, another's shipping documents, and a third's entry in the sales ledger. This allows them to efficiently cover all the critical control points for that type of transaction without getting bogged down following just one item that might not hit every single variation.
That makes sense. More efficient. So what specific techniques or procedures do auditors use during the walkthrough itself? I imagine it's more than just watching.
Oh yeah, definitely more than just watching. It's a combination, and relying on just one technique isn't enough. Inquiry is usually the starting point, asking the people who actually perform the process and the controls. Tell me about your role here. What happens next? How do you know this is correct? What do you do if you find an error? Are there situations where this control isn't performed?
Getting the story from the source.
Right. But inquiry alone is never sufficient. You have to corroborate what you hear. So they combine it with other procedures. Observation, actually watching the employees perform their tasks and control procedures. Does what they do match what they said they do? Reperformance, this is powerful. The auditor actually does the control procedure themselves. If the control is reconciling two numbers, the auditor takes the data and performs the reconciliation to see if they get the expected result and if the procedure works as described. Inspection, examining the documents, records, and system logs associated with the transaction being walked through, looking for signatures, timestamps, evidence that automated controls fired, matching information between documents, following the paper or digital trail. Corroboration. This involves talking to other people involved in the process, maybe supervisors or people in adjacent departments, to confirm the information received during inquiry. It provides a cross-check.
Okay, so it's a multi-pronged approach. Ask, watch, do it yourself, check the records, and double-check with others. That sounds pretty thorough.
It needs to be to get that reliable understanding.
So once they've done the walkthrough, they've seen the process, observed the controls, what's the immediate next step?
The immediate next step is to formally evaluate the design and determine the implementation of those identified controls. This is where they synthesize what they learned.
Okay, evaluate design, determine implementation. We touched on this, but unpack it a bit more.
Sure. Evaluating design is asking, is this control, as it's set up, capable of effectively preventing or detecting and correcting a material misstatement, either by itself or working together with other controls? Is the logic sound? Is it placed correctly in the process flow?
So could it theoretically work?
Exactly. And then determining implementation is asking, does this control actually exist in the company, and is it consistently being used? It's the reality check.
Right. Theory versus practice.
Precisely. A control is considered implemented only if it exists and the company is using it. And the auditor needs evidence that the people responsible for the control know it exists, understand their responsibility, and know how to perform it correctly. Just having a procedure written down isn't enough if the staff aren't aware of it or don't know how to do it.
How do they get that evidence for implementation? Is it the same walkthrough procedures again?
Largely, yes. The evidence for implementation often comes directly from the walkthrough itself. Observing the control being performed, inspecting documents showing it was done, like an approval signature, reperforming it, these all provide evidence of implementation. Inquiry helps too, but again needs corroboration. It's about gathering enough evidence to be confident the control isn't just on paper, it's actually operating.
Okay, so all this work, understanding the components, identifying relevant controls, doing walkthroughs, evaluating design, confirming implementation, it's a lot. How does all that detailed investigation feed into the auditor's overall job, the bigger picture?
It's absolutely fundamental. All of that work feeds directly into the auditor's assessment of the risks of material misstatement, RMM. You can't properly assess the risk of errors in the financial statements without understanding the controls the company has to prevent or detect those errors.
So understanding controls helps you figure out where the problems are most likely to be.
Exactly. Even if the auditor decides their strategy will be to rely primarily on substantive procedures, meaning they don't plan to explicitly test the operating effectiveness of controls to reduce other testing, they still need this understanding of control design and implementation just to make an accurate risk assessment.
Why, if they're not relying on the controls?
Because understanding the controls helps identify where weaknesses might exist, where errors could slip through. It informs their understanding of the inherent risks in the business processes. This understanding allows the auditor to make a preliminary assessment of control risk.
Control risk. That's the risk the controls won't work.
Essentially, yes. It's the risk that a misstatement could occur in an assertion, like revenue being overstated, and could be material either individually or when combined with other misstatements, and that it will not be prevented or detected and corrected on a timely basis by the entity's internal control system.
Okay, so higher control risk means the company's own safety net has more holes.
That's a good way to put it. And that assessment of control risk, combined with their assessment of inherent risk, the risk of misstatement before even considering controls, directly drives the rest of the audit plan.
How so? How does that risk assessment guide the actual audit work?
It directly informs the design of the nature, extent, and timing of further audit procedures. This is where the audit strategy gets specific. Nature. What kind of tests do we need to do? More rigorous tests and different types of tests. Extent. How much testing do we need? Test more transactions, larger sample sizes. Timing. When should we do the testing? Earlier in the audit cycle, closer to year end.
So if control risk is high,
If control risk is assessed as high, meaning controls are weak or ineffective, the auditor generally needs to perform more persuasive, substantive procedures. That might mean testing larger samples, doing more rigorous types of tests, like direct confirmation with third parties instead of just inspecting internal documents, or performing more procedures closer to the financial year end.
and if control risk is low.
If control risk is assessed as low, because controls are well designed, implemented, and the auditor plans to test their operating effectiveness and finds they work, then the auditor may be able to reduce the nature, extent, or timing of substantive procedures. The audit becomes more efficient because they can place some reliance on the company's own systems.
So the control understanding dictates the intensity of the rest of the audit.
Precisely. And the amount of understanding needed also varies. Factors like the company's size and complexity, the auditor's prior experience with them, the nature of the controls, manuals versus automated, the role of IT, recent system changes, and even the quality of the company's own documentation about its controls, all influence how deep the auditor needs to go to get that understanding and make that risk assessment.
Right, you mentioned documentation. After doing all this investigation, the auditor can't just, keep it all in their head. Documentation must be incredibly important.
Oh, absolutely critical. It's not just important, it's required. The auditor must document their understanding of the design and implementation of the entity's identified internal controls.
Why is it so critical? Just for the record.
It serves multiple purposes. It provides the evidence that the auditor obtained the necessary understanding. It forms the basis for their risk assessment and the design of further procedures. It allows supervisors to review the work done. And, importantly, it helps auditors in future years understand the system and how it might have changed. It's the audit trail for understanding controls. It's the blueprint.
Okay, the blueprint. What specifically needs to be in that blueprint? Does it list every single control they looked at?
Not necessarily every single one, but certainly the key ones. The documentation needs to include the key elements of the auditor's understanding of each of the 5 control components we discussed earlier. It should also note the sources of information used to gain that understanding: interviews, documents reviewed, observations made.
And which controls get the spotlight in the documentation?
The focus should be on the documentation of the auditor's evaluation of the design and implementation of controls that are most relevant to addressing the risks of material misstatement at the assertion level. This specifically includes controls related to those significant risks we talked about, controls over journal entries, and other adjustments. Any controls the auditor plans to rely on to reduce substantive testing, and definitely the relevant general IT controls that address IT risks.
Okay, focusing on the high-risk and strategically important controls.
Exactly. And the documentation shouldn't just be a list. It needs context. It should link the controls to the entity's overall processes and describe how those controls contribute to the completeness, accuracy, and reliability of the financial data that flows into the financial statements. It needs to tell the story of how controls safeguard the numbers.
Our source mentions several specific ways auditors can document this understanding. These sound like the practical tools they use. Let's dig into those.
Yeah, these are the common methods you'll find in an auditor's working papers. Each has its strengths. First up, flowcharts. We talked about these visually. A flowchart uses standard symbols to map out the sequential flow of documents, processes, and authority within a system.
The visual map.
Right. They're really powerful for understanding complex processes at a glance. Auditors use them both for overall systems, like the entire sales cycle, and specifically for understanding data flow within automated IT environments.
You mentioned 2 types.
Yeah, typically system flowcharts, which track documents and processes through different departments or functions, showing who does what and where information goes. And sometimes program flowcharts, which get into the logic inside a specific computer program, though auditors use these less often than system flowcharts. Good flowcharts flow logically, usually top to bottom, left to right, use clear descriptions, and employ standard symbols consistently.
Right, those symbols. Can you remind us of a few key ones, just to paint the picture?
Sure. The basic rectangle is a process or operation, manual or computerized. The document symbol, looks like paper with a torn edge or a trapezoid, is for things like invoices or reports. Arrows show the direction of flow. A diamond is always a decision point, yes, no. A cylinder typically represents a database or online storage. An upside-down triangle often means a physical paper file. Knowing these symbols lets you read the process map.
Okay, flowcharts give the visual. What else?
Internal control questionnaires, ICQs, these are essentially checklists. Often they use yes-no questions structured around specific control objectives. A no answer typically indicates a potential control weakness that needs further investigation and explanation by the auditor.
So a systematic way to ask about key controls.
Exactly. They ensure consistent coverage of important areas. Some ICQs might be more open-ended, prompting narrative answers instead of just yes-no. Then you have narratives, or written descriptions. This is basically writing out in paragraph form what a flowchart shows visually. The auditor describes the flow of transactions step by step, explaining the process, the documents involved, the controls performed at each stage, and who is responsible.
Like telling the story of the transaction?
Precisely. Narratives can be easier to prepare for less complex systems where a full flowchart might be overkill. They provide that clear, sequential story. The source gives an example of tracing a purchase order all the way through. And finally, auditors often leverage documentation from the client itself. Why reinvent the wheel? Companies often have their own procedures, manuals, process descriptions, and organizational charts.
Right.
Auditors review these client documents as a starting point to understand how the system is supposed to work and who is responsible for what, according to management. It gives them valuable initial context before they start their own detailed testing and documentation.
Okay, this all sounds incredibly thorough. A well-designed system documented with flowcharts, narratives, questionnaires. It seems pretty robust, but nothing's perfect, right? What are the inherent limitations? What can still go wrong even with good internal controls?
That is such a critical point, and the source emphasizes it strongly. Internal control provides reasonable assurance, never absolute assurance. No system, no matter how well designed or meticulously implemented, is foolproof. There are inherent limitations.
Okay, what are they?
First, and arguably the most significant, is the potential for management override. People at the top of the organization have the authority to bypass or ignore controls that apply to everyone else. They might do this to manipulate financial results or for personal gain.
Mm.
Auditors have to specifically consider this risk.
So the controls might be fine for regular employees, but management can just step around them.
Potentially, yes. That's a major inherent risk. Second is simple human error. People make mistakes. It could be a mistake in designing a control, an error in operating a control, like a typo during data entry, or just poor judgment in a situation requiring discretion. Controls rely on people, and people aren't perfect.
Right. Fatigue, distraction.
Exactly. Third limitation, collusion. Many controls, especially segregation of duties, are designed to prevent one person acting alone. But if two or more people conspire together, they can often find ways to circumvent controls that would catch either of them individually.
Ah, teamwork makes the dream work for fraud in this case.
Unfortunately, yes. Collusion is much harder to prevent or detect. Fourth, you have external events. Things totally outside the company's control, natural disasters, sudden economic crises, major technological disruptions, pandemics can overwhelm or disable even well-designed controls.
Things you just can't plan for perfectly.
Right. And fifth, a subtle one, the suitability of the entity's objectives themselves. If the company sets objectives that are unrealistic, inappropriate, or even illegal, the controls designed to achieve those objectives might function perfectly, but the outcome is still bad. Controls are designed around objectives. If the objectives are flawed, the controls can't fix that fundamental issue.
Wow. So management override, human error, collusion, external events, and even flawed objectives. It's a sobering reminder, isn't it, that even the best systems have vulnerabilities.
Yeah, it absolutely is. It underscores why auditing requires professional skepticism. You assess the controls, you understand their strengths, but you always keep these inherent limitations in mind. Reasonable assurance is the goal, not unattainable perfection. Hashtag tag tag outro.
Wow, what a fascinating journey through the inner workings of financial reliability. From understanding the big picture control environment down to the nitty-gritty of IT controls and walkthroughs, it's so much more than just ticking boxes.
It really is.
It's clear that internal control is this dynamic, layered system. And the auditor's role, well, it really does seem like part detective, part architect, meticulously examining the structure to ensure it's sound.
That's a great way to put it. We've seen how understanding the control environment, knowing the difference between preventive and detective controls, appreciating the massive role of IT, and using structured methods like walkthroughs.
Hmm.
All of these are essential pieces for ensuring that financial reporting is actually reliable.
Mm-hmm.
A constant process of vigilance, critical thinking, and applying professional judgment, always striving for that reasonable assurance.
So what does this all mean for you, our listener? Well, hopefully the next time you glance at a company's financial statements, maybe you'll have a bit more appreciation for all the unseen systems, the controls, the processes working behind the scenes to make those numbers trustworthy.
Yeah, it really highlights that genuine confidence in financial information isn't just about the final numbers. It's deeply rooted in the integrity and the robustness of the processes that generate them, that silent machinery.
Absolutely. All right, time for our final provocative thought.
Okay, let's see. Given everything we've discussed, the increasing complexity of IT, the constant reliance on automation, but also that persistent, unavoidable human element with its potential for error or override,
Yeah.
how might emerging technologies think really advanced AI and maybe mature blockchain implementations? How might they fundamentally reshape these concepts of internal control and auditing in the next, say, 10 years? Could technologies like blockchain, with its potential for immutable distributed records, make some traditional controls, like reconciliations, almost obsolete? Or will they just create entirely new, perhaps even more complex risks and controls that auditors will need to grapple with? Will the future be less about human checks and more about trusting the code?
Ooh, that's a great one. Will technology solve the limitations or just create new ones? Something definitely to ponder. Thank you so much for joining us on this deep dive into internal controls and business processes. We genuinely hope you feel a bit more clued in, maybe even inspired to look a little closer at the systems that underpin so much of our economic world.
Thanks for listening.
Until next time, keep digging, keep questioning, and keep learning.